I'm Rich Bachman from The Real Deal, and I'm here today with Rob Verrone from Hound Management, and we're going to talk about workouts, what's going on in the debt markets now. Rob, thanks for being with us today.
Good morning. How are you?
Doing well, thanks. So what's keeping you busy? Is it the debt placement now? Is it the workouts?
Well, debt placement is basically dead, right? So there's not really our entire pipeline basically came to a halt in March, and a few loans will survive. Everything else is just going to become a workout or a put a pin in, worry about it another time.
Mm-hmm.
So yeah, it's really what's keeping us busy right now is our workout business.
Yeah, you mentioned some of the deals you had in the pipeline earlier. One of the big ones that made headlines was the Daily News building that you were working on with Street and Deutsche Bank. Can you walk us through how something like that happens when you're in the middle of that and the world stops?
You just said it, right? You're trying to close a transaction, and for whatever reasons, I don't want to say too much on the deal, but for whatever reasons, it took a long time from the time we took it under application to the time we were prepared to close, and unfortunately, we weren't able to close. You know, the world changed. The world changed. Listen, what everyone should learn. We all got lazy in terms of how long it took to actually close a loan. Right. And when I used to be a lender, I had borrowers that closed loans repeatedly, 20 days start to finish. Right? They sign an application, they pay a little more to the third-party providers, they get the third-party reports done, they get in a room and they close it. And nowadays, 20-page loan docs have become 180-page loan docs, and every decision is just talked about and negotiated forever, and we all just took our eye off the ball. And loans, hopefully, the older guys like myself will tell the younger guys, like, shit, stuff does not have to take this long, right? We can make decisions and get loans closed quicker. And I think we all just always assume the markets were going to get better. Lenders were always going to be there. If lender A waffled, we'd go to lender B, and that stopped. And now everyone's got a little religion.
And are you working on any deals now that are specifically seeing stress related to COVID, or are they?
Yeah, I mean, so I would say in the last 5 days, the workouts we took under engagement are all COVID related. But what we're really focusing on is more loans that were maybe teetering right before COVID, and then COVID put them under, versus a property that is a very low leverage, high debt service coverage property that just has maybe a 30 or 60 or 90-day issue. We're not spending a ton of time on those.
Mm-hmm. If someone bought a retail property at the height of the market and it's been sitting vacant because they can't lease it, what kind of workout can you do in a loan like that?
Are you talking about New York City kind of street level retail?
Yeah, high street.
It's an issue, right? If you bought something at the height of the market, and depending on when you bought it, not only you have three issues. One is you have probably the rents you underwrote to are, even before COVID, were probably 30 to 50% less. The taxes are probably 20 to 80% more. And even if you could drop, again, this is all pre-COVID, even if you could drop the rents to a level that was market, there really weren't any tenants. So you really, at some point, have to make a decision to either just continue to fund your debt service until maturity or default, and we'll go take our best shot with the lender. Unfortunately, these loans have very large loss severity if you try to actually do a discounted payoff on them, and the lenders aren't willing on a lot of them to take the losses right now.
Mm-hmm.
So it's a little bit of everyone's wait and see.
Mm-hmm. Do you think that we're going to see a lot of distressed notes hit the market?
You are going to see a lot of distressed everything, right? Especially in the high-end retail in New York City. You're going to see note sales. You're going to see maybe consensual cash for keys where they pay the borrower a couple bucks to go away and not fight a foreclosure, and then they sell the REO as quickly as they can when the courts open up. You're also going to see some lenders who think they could rent space better than the New York City operators. So you're going to see some lenders try to take title to properties and actually run the properties and see if they could lease it. But yeah.
We've heard for the longest time that lenders don't want to take it back because the sponsors, the developers, are in the best position to handle the properties. Do you think that people weren't being entirely candid when they were saying that? Or do you
I think it's 100% true. I think the special servicers, if you're talking about a CMBS loan or a balance sheet lender, if we always say if you have three things: if you're not a thief, if you're competent, and if you have cash in whatever form you need to have cash to reinvest in the property, the lenders will work with you to try to do a workout and figure out how to let you still control the property and let the lender get the best recovery. The problem is when borrowers think that their lender is their partner and they don't respect the debt and equity relationship. Right? You can't have a property that you bought for $30 million and now it's worth $100 million. Right? If it goes from $30 million to $100 million, you're not giving your lender any more than $30 million. But there's a lot of borrowers that think when a property drops, the lender should share 50-50 or maybe even 100% in the diminution of value. And most borrowers understand that they have to pay up a little bit to get a workout done. If the only thing you're doing is giving the lender the exact same amount of money they would get by either owning the asset or selling the asset, then why do they need you? Right? They could just take title and foreclose you out and keep 100% of the upside, and maybe they get lucky. You have to overpay a little bit to get a workout done.
Mm-hmm.
And there are definitely some borrowers that don't understand that.
What about forbearance that the special servicers are offering now? Is it across the board that they're offering a few months if you can show that you've been impacted by the pandemic?
You're talking about the special servicers, right?
Yeah.
I said this on a phone call that I was on, a webinar that I was on last week, right? A lot of borrowers, and I think there's just some bad information out there, feel that there's like some forbearance fairy flying around and just sprinkling dust on loans that are COVID affected and giving 90-day forbearances. I don't think I know that's not the case, right? What I think the industry is trying to do is there's a two-prong approach. Prong one is if you have a temporary cash flow issue and you have reserves that can be reallocated to pay your debt service, there is a process where that is much easier than it has been in the past, and borrowers can tap into the reserves to pay debt service, and then we'll just come up with a formula to fill up the reserves again when hopefully the world comes back to normal. If you're looking for debt service forgiveness, then it's a negotiation. It's the loan 99 out of 100 times has to get transferred to the special servicer. The special servicer has to underwrite it and understand it, and you have to make a proposal, and that proposal needs to, again, back to my debt is debt, equity is equity. Like, they're not just going to waive debt service for 6 months without you contributing anything to the equation, to the solution. So you may have to agree to pay operating expenses, pay ground rent, pay taxes and insurance, something, right? What are you doing to help solve the problem? Mm-hmm. And I will tell you, it's probably less than you would have had to do pre-COVID. I think everyone on the lender side understands that in 2009, when we did workouts, if a guy had 20 buildings, if a company had 20 buildings, 5 of them were in distress. Now, if you have 20 buildings, 20 of them are in distress. So writing that check every month is a little harder nowadays, even for the most affluent borrowers. If we found someone who has workout experience and it's real workout experience, not a broker who helps someone get an assumption approved once, or but there's not a ton of real workout guys, and if they are, they're probably getting scooped up by the special servicers right now. So yeah, we're definitely looking. I do think there are a lot of shops out there that say they do what we do, and I think they just like to tell the borrower whatever he or she wants to hear.
Yeah.
I think there are some shady workout advisors out there.
What are some of the tough truths that you've had to tell clients?
Debt is debt. Equity is equity. No one is doing a discounted payoff on your asset based on the value you think it's worth on, April 22nd, 2020. We tell them all the time, you have to have cash to solve problems, right? It's not a free option. We also tell them they have to have a plan. Hands can't just be in the air saying, I don't know what to do, right? What is your plan? Why are you the right person to run this asset through COVID and post-COVID?
Mm-hmm.
Borrow. It's not a free option. It's not a free option. And the lender's not your partner. That's the big thing we tell them all the time.